right. So today we're going to take a deep dive into the world of Walter Schloss.
Walter Schloss. Yeah.
He's not a household name like a Warren Buffett,
Right.
but his track record is incredible.
Oh, yeah.
We really want to unpack how he did it.
Absolutely.
We've got interviews, articles, analyses of his methods.
A lot of good stuff.
And it's fascinating because no college degree,
No.
super simple office, never even talked to company management.
That's right.
So how did this guy generate these amazing returns? That's our mission today.
Yeah, and the headline number is a 15.7% average annual return over 47 years.
Wow.
I mean, think about that.
That's incredible.
Consistently beating the market for almost half a century.
Yeah.
The S&P 500 only did 11.2% over that same period.
Right. And it wasn't just he picked 3 stocks and got lucky. There were over 1,000 different securities he invested in.
Yeah, so we're not talking about some, market timing genius or sector specialist.
Right.
This was a system, a philosophy that worked across the board.
So rewind the clock. Who was Walter Schloss?
Well, no fancy college degree here.
Okay.
He started as a runner on Wall Street.
Really?
Imagine, fetching coffee and making copies.
Wow. Humble beginnings.
He lands a job at Graham Newman, working directly with the father of value investing, Benjamin Graham.
Oh, wow.
And alongside a young Warren Buffett.
Oh, man.
Talk about an education.
That's incredible.
Yeah.
That's where he learned about those cigar butt stocks, right?
Right.
These companies that have some value left in them, even though they're not, the hot new thing.
Precisely. The idea is they're trading for less than their intrinsic worth.
Yeah.
Like finding a few puffs left on a discarded cigar.
I love that analogy.
Yeah.
And in 1955, he takes that knowledge, a mere $100,000 from a handful of investors, and starts his own fund.
Working from a tiny office, too.
It's just amazing to me that people trusted him with their money back then.
It speaks volumes about his character and his ability to instill confidence in his approach.
Yeah.
Yeah.
Okay, so let's break down that approach. What was he actually looking for in these cigar butts?
He was all about the numbers.
Seeking
out what he called quantitatively cheap stocks.
Quantitatively cheap.
Okay, this meant companies trading below their working capital.
So not looking at future growth projections,
No.
what the management team was saying they were going to achieve.
He wanted to see hard assets.
Hard assets.
Margin of safety in case things went wrong.
And famously, averse to debt, right?
Absolutely. Companies he invested in had to have clean balance sheets,
Right.
avoiding the risks that come with lots of borrowing.
And this kind of all ties into his overall risk management philosophy too.
Absolutely.
He didn't just bet it all on one horse.
He was a master diversifier,
Diversifier.
often holding over 100 stocks at a time.
Wow.
Yeah,
So that way, even if a few picks didn't work out,
right.
the overall portfolio remained pretty stable.
Exactly. It was a way to weather market storms and individual company setbacks.
Now, this wasn't, day trading, was it?
No, he was not a day trader.
This guy was playing the long game.
His average holding period was 4 years,
4 years, just let it sit.
letting his investments mature patiently.
And speaking of long-term thinking, I want to get into his relationship with, Ben Graham and Warren Buffett.
Of course.
So both Schloss and Buffett learned from Graham.
Yeah, at Graham Newman, absorbing those value investing principles.
But their styles evolved a little differently.
Yeah.
Buffett kind of moved towards holding great businesses for the very long haul.
Right, whereas Schloss remained more focused on those quantitative metrics, buying and selling purely based on valuation.
Interesting.
Yeah.
But even though their paths diverged, Buffett still considered Schloss a super investor.
He did, very much so.
So these are two students of the same master, right?
Yeah.
Achieving incredible success, but in their own unique ways.
Exactly.
Now, what's interesting to me is how did Schloss determine how much to invest in each of these cigar butts?
Position sizing.
Position sizing.
The unsung hero of investing.
Yeah. So how did he figure out how much capital to allocate to each position?
He had a system based on his confidence level in each investment idea.
Okay.
It was a sliding scale based on the margin of safety.
Margin of safety, okay.
Which is the difference between the stock price and his estimate of its true worth.
So the bigger the discount, the bigger the bet he would make.
Exactly. But he also balanced this with his diversification strategy.
Right.
Even his highest conviction picks were capped at a certain percentage of his portfolio.
Smart. That way, even if one position really went south, it wouldn't, sink the whole ship.
Right.
Now, Did his approach to this position sizing change over time as he got more experience?
That's a great question.
Yeah.
And we're going to delve into that more in the next part of our deep dive.
Okay, cool.
Yeah.
So stay tuned because we'll also be exploring his relationship with Graham and Buffett in more detail as well.
Looking forward to it.
Can't wait. This is already fascinating. Welcome back. So we were just talking about how Walter Schloss figured out, like, how much to invest in each stock, his position sizing.
Right. Yeah, you asked if it changed over time.
I'm curious, like, did he tweak it as the market shifted or he got more experience?
You know, it's fascinating. His core principles were really consistent throughout his whole career.
Really?
Yeah.
So even when the market was, going up and down, his position sizing stayed true to those initial ideas of margin of safety diversification.
Yes. He always aimed to buy stocks significantly below what he thought they were actually worth, creating that cushion.
Yeah.
And he never strayed from spreading his bets,
Right.
which really helped him manage risk over all those years.
It's almost like he found a formula.
Yeah.
And he was like, this works. I'm sticking to it.
Discipline. Definitely a hallmark.
It makes his decision to close his fund in 2001 even more intriguing.
Oh, yeah?
Like, why would you close up shop when you're doing so well?
He shut it down because he couldn't find any cheap stocks. He actually called the market extremely overpriced.
So he's killing it, but because he can't find anything that fits his criteria, he's just like, I'm out.
That's conviction.
That's
It's his commitment to those value investing principles.
He wasn't going to chase returns.
No.
He was just like, this is my system. If I can't apply it, I'm not going to play the game.
And he saw that dot-com bubble inflating.
Right.
And rather than compromise, he stepped back.
What worried him specifically about the market back then?
He was concerned about the concentration of money into just a small number of large companies.
Yeah, back then, anything with .com in the name,
It didn't matter.
people were just pouring money into it.
It was that classic irrational exuberance.
And Schloss, Mr. Hard Numbers, he's looking at this like,
Yeah.
that doesn't make any sense.
This is nuts.
So how does this all apply today?
Yeah.
Has the investing landscape changed too much?
That's the million-dollar question. While the market has definitely evolved, the core principles of value investing, they remain timeless.
Timeless. Yeah.
Buying things for less than they're worth, being patient, managing risk.
But I feel like finding those classic cigar butt stocks, it's harder now.
Yeah, it's a different environment.
Everything seems expensive.
Right.
Especially with, tech giants kind of dominating everything.
Well, remember, Schloss was a master of finding those hidden gems
Yeah.
in overlooked corners of the market.
It's like those Rust Belt stocks.
Exactly.
Everybody else was like, ew, gross.
Stay away.
But it's like, no, there's value there.
There's value.
So maybe the cigar butts just look different today,
Yeah.
but the principle's the same.
Find the value that others are missing. Be patient.
And don't forget about debt.
Oh, absolutely.
Schloss hated debt.
He hated debt.
It was like a huge part of his risk management.
And it's even more relevant today.
Oh, yeah.
With companies so heavily leveraged.
Right. If you have less debt,
Yeah.
you're less vulnerable when things go bad.
Precisely. So while finding those screaming bargains, it might be tougher now.
Yeah.
Schloss's approach is still incredibly powerful.
Discipline, patience, focusing on what something's actually worth.
Timeless.
But I got to ask,
Yeah.
if Schloss were alive today, how would he navigate the whole tech and innovation scene?
That's a great question.
Because he seemed to like those, more traditional businesses.
He wasn't really a fan of high-flying growth companies.
Right.
Especially those with, unproven business models.
Right, right,
But I don't think he'd ignore the entire tech sector.
right.
I mean, some of these companies are creating real value.
They're disrupting entire industries.
I think he'd apply that same rigorous analysis.
Yeah.
Looking for strong fundamentals, reasonable valuations, and yes, minimal debt.
So even in the tech world, maybe there's some Schlossian bargains out there.
Absolutely. That's what's exciting about these investing legends.
Yeah.
Their core principles, they often transcend specific industries or market cycles.
It's like a mental model
Yeah.
you can apply anywhere.
Exactly.
Before we go to the last part of our deep dives, I
Yeah.
want to just take a moment and reflect.
Okay.
What's resonating with you most about Schloss's approach?
For me, it's that combination of discipline and patience.
Yeah.
He had a system, stuck to it religiously,
Yeah.
and he was content to let his investments compound over time.
He wasn't chasing those quick profits.
No, he was not.
Yeah, that long-term thinking, it's so important,
Especially
in
today.
this world of like instant gratification, everything.
Everyone wants it, and now.
Everyone wants it now. But Schloss, he shows us that slow and steady
Yeah.
can win the race.
He's the tortoise, right?
He is the tortoise, yeah.
Yeah, in the fable.
Okay, so let's distill some key takeaways here.
Absolutely.
From Schloss's journey, let's make this actionable for our listeners.
Okay.
First and foremost, discipline, right?
Yeah.
He had his system.
He stuck to it. Religiously. Didn't matter what.
No matter what the market was doing.
Emotions, market swings, nothing swayed him.
And those returns, decades of outperformance, that shows the power of that discipline.
Yeah, it really does.
So lesson number 2, don't be afraid to be a contrarian.
Yeah, Schloss often went against the crowd.
He did.
He found value where others just saw risk.
Like those Rust Belt stocks we talk about.
Exactly.
He wasn't following the herd.
He's looking at the fundamentals.
He had the courage to trust his own analysis.
Even when it was unpopular.
Which leads us to lesson number 3, patience. Man.
Oh, yeah.
Schloss was the ultimate long-term investor.
He was.
Comfortable holding for years.
Letting things compound.
Yeah, he got that wealth takes time.
It does.
You don't need to chase those quick profits or get caught up in the day-to-day noise.
Tune it out.
Tune it out. And finally, lesson number 4.
Yes.
Risk management.
Schloss, he was the master.
How'd he do it?
Primarily diversification and his aversion to debt.
He spread his bets.
Yep. And focused on companies with those strong balance sheets.
So he minimized the chance of like a catastrophic loss.
Exactly. Protecting your downside.
Just as important as...
It's maximizing the upside.
Okay, so to recap,
Yeah.
discipline, contrarian thinking, patience, and risk management.
Powerful stuff.
And he did all this from a tiny office with a single phone, right?
That's right.
Like, you don't need all the fancy tools
Yep.
to be a successful investor.
You just need the right mindset.
The discipline and the willingness to put in the work
And to be honest with yourself.
about what you know and what you don't know.
Schloss stuck to his strengths, those quantitative metrics.
He didn't try to be something he wasn't.
Exactly.
So as we wrap up this deep dive,
Yeah.
think about how you can apply these lessons to your own investing.
Do you have a discipline system?
Are you comfortable being a contrarian?
How are you managing risk?
And maybe most importantly, are you patient enough
Yeah.
to let your investments truly grow over time?
Because, as Walter Schloss proved, slow and steady, it wins the race.
Especially in investing.
Especially in investing.
That's all the time we have for today.
All right.
We hope you enjoyed this deep dive into the world of Walter Schloss.
Fascinating guy.
Until next time, happy investing.